A very good afternoon. Uh, Thank you so much, sir, for asking that question on global markets. That puts my session in perspective. I'm going to talk about have you invested globally yet? The the intention is not to tell you that don't invest in Indian markets and go and invest in global markets. We're just trying to showcase what is available out there and how you can add the global markets in your portfolio. So I know that many of you may be thinking that we are talking about invest in India, make in India, bring everything to India, and why is this guy standing here and saying, have you gone global or not? So the idea is that, we basically what we do is we help people create, their portfolio in the global markets. So there are a few reasons as to why you should do it and how you can do it. What are the government rules and guidelines around it? So we'll just go through slide by slide. If you have any questions, please note them down. We'll take it at the end of the session. Thankfully, we have a stall here, so you can always come and pick my head later if you want to. So can we have the next slide, please? Thanks. Just next. Thank you. So it's a funny article actually. I was going through, I've done a little bit of research before coming here on the presentation, and what I realized was that there are a lot of funny things that I've found. So this is one of them. The article says that less than half or 48% of American adults have money in stocks. 48% of Americans, guys, So that's like a huge number, isn't it? And they are still worried about it. So just to give you an understanding that not only in US but overseas, stock markets have been considered as one of the investment options available to people, and they take it very seriously. Unlike in our country where only a select few attending Finbridge Expo will probably invest in stock markets, but that's not the case overseas. So next slide, please. So, see what also we have to realize is that no matter how much we do our own analysis and own study, we try to pick no matter how many good stocks in India. It has to be said that our markets are or the volatility of our markets is dependent on FIIs to a lot of extent. The money that is coming from the foreign people inside India. So whenever these people invest in India, our markets go up. Whenever these people take their money away, our markets go down. So just I'll spend 2 minutes here. So who are these FIIs? When we talk about these FIIs, these are nothing but foreign institutional investors or FPIs as we are calling them now, the foreign portfolio investors. So basically these are companies which are in the overseas markets. They collect money from overseas people, and on behalf of them they invest in different markets. So for them India is an emerging market. So there is a concept of emerging market and developed market. So India is an emerging market for them. So they take money from those people, they come here and they invest. It is something like if you talk about DIIs, that is the domestic institutional investors. The major ones are mutual funds, for example. So that what do mutual funds do? They will collect money from you and they will invest in the market. So FIs are no different. So a lot of dependence on foreign institutional investors, and why I'm stressing on that is because we need to consider that how these people are influencing the Indian markets, and realize that we cannot do that. We cannot go other way around and go and influence their market. So it is very important to see that why we are dependent on global markets, and that is because FIIs form a huge chunk of Indian markets. Next slide, please. And why is that? Why is that the FIIs control the volatility of the market? Some facts and figures basically the savings that people do in India, or the number of investors in India in the stock markets, is very low. I mean, I don't have to stand here and tell you that. It's a known fact. Stock markets has a lot of negativity attached to it, and that's why Indians do not tend to invest in it. If someone is doing trading, he's considered as a Vela guy. He's like, he has nothing else to do, and that's why he's trading. Or he doesn't know anything else. But it's a fact of life, and there are a lot of reasons for it. I come from a financial education background. I have been doing that for more than 4 years now, and I realize that there is a lot of lack of education in India about stock markets and investing in stock markets. The reasons are a lot. Having said that, you can actually see that we are about 10 to 12 billion a year is what we invest, which is like really, really low number. Now, where are we talking about like 48, 50, 55% of people in US investing in stock markets? As compared to us, we are like nowhere, we're not investing a lot. Even China is a bit better than us in terms of investing in stock markets. Next slide, please. So these are some mutual funds numbers. Pardon me if they are old or if they are wrong. I will correct it, but this is what I found it available in the publicly available domain. You'll probably realize that, when you compare these numbers, you will see as to how small we are in terms of even in mutual funds investing in stock markets. I am not saying you go and put all your money in mutual funds to kind of pump it up, but what I'm trying to say is just compare. That we are at what, 0.19 trillion as compared to about 16 trillion. Yeah, we are talking about trillion. I don't know how many zeros are there. Probably even you will count, right? So it is very important to understand these factors, because this will give you a perspective of why it is that we are dependent so much on FIIs. Next slide, please. Just number of investors. We are what, about 1.32 billion people. Yeah, I mean, we are a lot of Indians. If I go everywhere, you'll see Indians. Same with Chinese. But look at the number of people who are there. I'm talking about people who have invested in stock markets directly, indirectly, and you'll probably realize that we have a long way to go. Next slide, please. Well, just to spend a little bit time on globalization, everybody talks of globalization, especially I come from Bangalore, which is called the IT hub, and you probably would know that globalization and IT go like hand in hand. So why is it that we are not talking about the same thing in finance? And if we are doing, then why it is like a bad thing, if you probably, most of us get a lot of WhatsApp forwards, right? And recently I think there was some forward which was a small video in Mumbai. Probably a 5th standard guy was asking Mr. Rajan, anybody has seen that video by any chance? Yes. What was the video all about? I mean, this small fellow is trying to ask, sir, why is it that when the US interest rates change, our Indian markets and Indian people react to it so much, and why is it not the other way around? It was very nice how Mr. Rajan put it in perspective. He said that every country should be self-sustainable. Basically, the interest rate in India should affect India, or it should be managed in such a way that it does not have any global impact, which is not very possible in today's time, because the world trade is like huge, and something happening in one country is going to affect the other country. So putting that in context, it is very important to see what factors are there which are affecting global markets, or say Indian market in particular. So right now the hot topics are Fed interest rate. Everybody is talking about it. What is going to happen? Again, they are thinking whether in March they will increase or not. Thankfully, in December when they increase, it didn't had a lot of impact. But obviously, in a long term, you will see what happened in December. The US government increased the interest rate with 25 basis points. I'm not saying that is the reason that January was bad for India, but Another factor to consider is crude oil price. Crude oil price is something that is of very, very hot right now. See, every time we are trying to find something to kind of keep us entertained. And last year it was Greece. Every 1 or 2 years, Greece will come up, raise his hand, and everybody will start talking about Greece crisis. So right now it is crude oil. Crude oil is an important global concept. I have done a lot of research on crude oil. Maybe offline, if you want to know more about crude oil and how it affects the political, financial environment globally, please talk to me. I'll be more than happy to have that chat. But right now, as you know, crude oils are at rock bottom. You will see analysts talking about it going to $10. Someone say it will go to $5. Someone say it will not go any further down. It will go up from here. Also, you will see there is a lot of volatility associated with crude oil. Someday it will be 33, someday it will be 28. So all those things are happening right now, and because of that, there is a huge impact on how the global markets are trading. So that is another factor right now which is considered. Another thing is, see, everybody was very bullish on India and China. So the day they think that these countries are slowing down, that is another area of panic to them. So everybody is thinking that China is going to slow down. Even if it goes like 0.1% down, everybody panics that all the consumption is going to go down. Well, the fact of life is that whatever goes up has to go down, and then again has to go up. So that is what is going to happen eventually. European crisis, thankfully it is subdued right now. I think people are more excited about crude than the European crisis, but that does not mean it does not exist. There are countries which are on the verge of becoming bankrupt, and once we settle down with the crude, I'm sure that the European crisis will come up again. So that is another factor to look at. In the context of globalization, technology is very good now. You can, when you can sit and say buy a product from Amazon US, then why can't you sit here and buy the Amazon stock itself? So internet has helped a lot in investing in global markets. Next slide, please. So just look around you. I mean, look at some articles. I have just not gone anywhere, just one page. You'll see these kind of articles, emerging stocks jump 2% on fading Fed hike. So you see the correlation. Everybody is correlating what is happening in one market with another market. European shares get commodities boost. So that is another thing to look at. It is very interesting that when we talk about markets in emerging countries like India and China, we are comparing them with what is happening in the developed world. But when we are talking about developed world, we are talking about commodities in general or currency in general. So that is the difference. So when you talk about, say, US market, you will talk about how the interest rates are going to affect the market. They will not say that yesterday Indian market went up and that's why US market is going to go up today. That is not going to happen, right? So if you just look around you, you will see this difference that, the developed world is comparing itself with something that is happening from a monetary policy perspective or a fiscal policy perspective or from a commodity perspective. But in India, we have all that, and then we have the developed world and how it behaves. Next slide, please. So simple question to ask yourself. I mean, I'm sure there will be a lot of day traders, there will be a lot of investors. I'm a day trader too. And do you look at the US and European and Asian markets in the morning before you start trading? I mean, how many of you do that? Do you look at these markets before you start your day? You have to, right? Yeah, you will look at what happened to even SGX Nifty, right? That gives kind of derives as to what Nifty is going to do. So you cannot do that. Now I'm sure that a guy who is investing in US is not going to wake up and look at Indian market as to how the Indian market did, right? But being in India, we have to do it, So there is a factor to be considered that, we are not talking about just figures and numbers. We are talking about psychology as well, So we have a huge dependence on them, and and you should not be ashamed of denying it. It is just that, you know, it's there and it's a fact. Thank you. So why should you know, one think of it, not because just the psychology part, but there are other things as to why you should consider investing in these markets. They are pretty stable, you know, in terms of their their working, their volatility, you know, their management, all that is there, and it is pretty stable, and that is obviously one point to consider. There are very big firms overseas, you know, so there are a lot of opportunities for you to tap in. You can, you know, if you're buying a Tata Motors share, say in India, you can also consider buying a Toyota share on the Japan, the Tokyo Exchange, you know, so you can always do that. So I'm not going to use the word diversification, you know, because that sounds very cliche, but basically, if I want to sell this product, I will have to say that, you know, you will get a diversification aspect as well. So if you have an Indian corpus, tomorrow if the Indian market starts tanking like anything, but along with that, if you also have a US portfolio, you know, then you are side protected from the country movement, you know, so that gives you a lot of factor to consider in your portfolio. You should always have some money invested in some good global markets, and that will give you a edge over others who are only investing in just one country. So this is an interesting map. It gives you the map of the world from a perspective of the size of their stock markets. Next slide, please. But size, is it really matters? I mean, if I tell you that some market is so big, will you go and invest in it? I don't know, you know, but at least it's my job to tell you that size is there. You will see how big these markets are and where we are. So those red ones are us. You know, thankfully we are there in the top 10 now, but we are still way behind. So these markets are huge markets. The value is there in investing. I'll just go to that. Next slide, please. So this is just a table which tells you about different numbers of the value of the trades that are done and the volume of the trades that is done. You will look at it and you will realize that the number of trades in Americas are less than half of the trades in Asia Pacific, but the value of those trades is only 14% less. So we have lot of trades, you know, like I have seen people started their Indian accounts with 5,000 rupees and trading in those, you know. So yes, our volume is very big. We are very big in volume. Like if you talk about Nifty volume, we are largest in the world. But what is the value of those volume, you know? So that value is very less, you know. So as compared to what these developed markets are. So someone will say that there are not enough trades happening there. Yes, but the value of those trades that are happening is also good. So consider that in your consideration towards investing in global markets. Next slide, please. So when someone wants to track the world index, MSCI is a company based in US, and it comes up with this indexes for different exchanges. It also has come up with this MSCI World Index. Basically, it is an amalgamation of 28 different developed countries, and it will tell you as to how you know, these countries have fared, or the exchanges on these countries have fared. You will see that over the 5 years, you know, these 28 countries collectively has given about 3%. It doesn't mean that all the countries are good. It is just to show you that the developed world index for the last 5 years has gone up 3% annually. Next slide, please. The same thing with emerging market. They have come up with an emerging market index, and that has gone down by 6.8%. Again, I'm not saying that this is the reason that why you should invest in global markets, because these emerging markets, some of them are doing really good, some of them are doing really bad, and that's why the overall thing is bad. So it is very important to pick and choose which countries you are going to invest in. Don't go and invest in a country which is going to not give you good returns, or try to find a stock which is there in a particular country where you cannot invest. So pick the country where you want to invest, and that is also I will show you in a while. Next slide, please. So again, the same thing in a different format for CY15. Basically, the indices performance in Asia or emerging markets was really bad, and the global markets have been a bit stable comparatively. So Germany, Japan, France have done all right. USA and UK has kind of not fared well. I'm talking about 2015 here. Next slide, please. This is another index to look at. S&P 1200 is also a global index, and what it does is it takes shares across the world from different countries. So this is a slide to show you basically the top stocks which are there across 31 countries. And most of the stocks are there from US, Japan, and a few from Eurozone. From Eurozone also we are talking about countries like Denmark, Finland, and those kind of countries. So you'll probably realize that India is not there. So there are better stocks available outside India which are doing better than what some of the stocks in India are doing. So why not go and buy those stocks? Just one slide which was, I like Apple. I use Apple, so I like the Apple stock as well, and I have been tracking and following it so long. You'll see that about 12 years, probably that was the time I think when TCS came into existence on stock markets. Probably Apple has grown about 162% annually. That's like a huge return as compared to what probably the Indian peers would have given. So what if I would have put the same money that I put in TCS in Apple at that time? So just a thought to ponder on. Next slide, please. But then the thing is, are we just talking about US? Japan is another market to look at. If you look at Japan, there are a lot of reasons to invest in Japan. I mean, I'm not from Japan, so don't worry, I'm not going to promote their country, but the fact is that I like to find places where you can actually make money better. Yeah. And how many of you know rule of 70 in compounding? Anyone? Yeah. So rule of 70 in compounding says that you can actually double your money in the number of years, and how you calculate those number of years is you divide 70 by the interest rate that you're going to earn. So simple example is that if you're going to say get 35% interest on your investment, you're looking at doubling your money in 2 years. That is 70 by 35. That is rule of 70. So if you look at Apple, that rule of 70 is not even required. So that does not mean you have to go and buy Apple now, but I'm just saying that that was an opportunity which probably most of us missed. At least not, I didn't miss, but most of you did. So, but then, are we then just looking at US? We are talking about Japan, which is another country. The Nikkei has done really well there, and you will see that it has outperformed us. Maybe not on 10-year scale, because it was, in the initial 5 years it went down. But if you look at last 15 years, it has outperformed us. In the last 5 years, it has outperformed us. The interesting thing that the Japanese government has recently done is they have reduced their interest rate down from 0. It is negative interest rate. Traditionally, what has happened is that countries which have done that, people have seen huge growth in those stock markets for whatever reasons. So, and apart from this also, there are many reasons as to why Japan is a country where one can consider investing. Another factor I can give you is that Japanese companies are very cash rich. The amount of cash that they hold is like huge, and that is not tapped at. If they start tapping, then we are looking at a huge jump there. Next slide, please. some 10 best stock markets in 2015. Yeah, and you will see that these are the countries which are there. You'll see Argentina, Hungary, Denmark, Ireland, yeah, Russia, even Pakistan has done better. So uh, this does not mean that you go and start exploring these countries or investing in these countries, but just to give you a perspective that if you look at the you know markets which have done well in a particular uh, year, then are we featuring in there? We are talking about India or say Nifty going up, going down by so many percentage. But then just open your eyes. There are, things available for you to look at countries or markets apart from our country as well. Next slide, please. Again, going back to the US story, how many of you here know Warren Buffett? I know it's a stupid question to ask, but a lot of people like to follow. Sorry. Hello. Can you hear me? Yeah. Okay. So you just follow him. Buy go and buy Berkshire Hathaway, and just keep it with you. Like you can just frame it and put it in your house. It is that kind of share. That is what people in US do. So that is another thing that you can do. About 20 years, last 20 years, he has been able to generate annualized 21% returns. That is really amazing. Probably in the last 10 years, it has gone down to about 11-12%, but it's still better. So that is another thing to look at when you are considering investing. You just follow the guru. Next slide, please. Okay, I'll take some time here. This is a very good chart. Basically, Telegraph Money in UK, in 2014 they have started this study where they are comparing the PE ratios, the trailing PE ratios, and the price book value ratios of countries with their historical averages. Based on that, they have come up with this concept of cheap stock markets or undervalued stock markets. They come up with this list in 2014. They came up with one. 2015, they have kind of increased the number of times they are bringing this. So they did it in June, they did it in September, they have recently done again in Jan 2016. What it shows is all the green ones are cheap or undervalued markets. You will see names like China. I know it's not visible, but that's why I put all that in green there. So you will see China, you will see Russia, Pakistan, Turkey, Hong Kong, Austria, Poland, Spain, Japan. So these are the countries which are undervalued right now. Countries like Japan, Russia have been there since 2014. They have been undervalued only. So you'll probably don't realize that we are not looking at these markets at all. I'm only worried about what my Indian market is going to do, what Sensex is going to go, what Nifty is going to do. So based on this study, if you want to ask me as to which market I should go and invest in 2016, I'll probably say go and invest in Japan or consider stocks in Russia. So just to give you an idea of which country should I start with. It is like people come and ask me which stock should I buy in India, where should I start? I mean, there are so many. So obviously there are so many countries, so where should I start? So these are some facts and figures which will help you in starting with having a starting point. Mind you, US is very expensive. It is on the expensive side. The most expensive is Belgium right now, but that keeps on changing based on the PE and trailing PE, 10 years trailing PE. Next slide, please. This is another thing. In fact, there was one gentleman at my stall right now, and he was saying this to me, that what about then currency fluctuation? So if you look at short period, then yes, you probably will take a hit on currency. It might appreciate, but if it depreciates, you are going to earn anyways. But over the last about 10 years, so USD has kind of gradually gone about 2.5% up. So that is another factor to think. If you're looking from a longer perspective, say 1 year, 3 years, then the currency fluctuation is going to take care of itself. But yes, if you're looking at a short term, like I want to do a day trade or I want to do a say 1 month trade, then yes, you will probably have some bit of currency, exposure, and there is nothing to deny it. But however, having said that, there are a lot of factors in at least 2016 that show us that Indian currency is not going to appreciate, at least not in the near future. So again, a lot of things can actually be discussed around it. We'll probably take it offline if you want to. But currency fluctuation is one factor that you probably would like to consider when you're investing in global markets. Next slide, please. So how do you invest now? You have spoken about, opportunities there, and we have spoken about why we should consider them. But how do you go about it? How do you start investing in this market? So one way to do it is you invest through mutual funds. There are a lot of mutual funds available out there which invest in international markets. So that is one easiest way to kind of go. You just start with them. However, you can look at the returns that they have been able to generate. I think only Motilal's most shares Nasdaq 100 ETF has done about 17%. So apart from that, none of them has fared well. So if you're considering mutual funds, Indian mutual funds have probably done better than these mutual funds. So again, you have to consider whether you want to go through them or you can do it directly. Next slide, please. This is just a slide to show you as to where the Motilal guys have invested through their mutual fund. You'll see all good shares there. You'll see Apple at the top. So you'll probably realize that these are the stocks that these companies, the fund which has done well, investing in international funds. You see all known names. The advantage of trading in say US market or say Japan's market also is that most of the names are known names, because a lot of people are comfortable in investing in those companies which they know about. So we'll see names like Apple, Microsoft, Amazon, Google, Facebook, Intel, Cisco. So all these names are known to us. So it is not very difficult to get information about them and kind of invest in those companies. Next slide, please. Another way of investing in international markets is obviously, one was mutual funds, the other is you open an account with an international broker. So please consider us as well. I mean, we are here. We can help you do that. We are partnered with a global brand, and we can help you invest in international markets. Open an international trading account, which will help you invest in, all the markets that I have spoken about. And there are some government guidelines which I will talk about in just a while. Next slide, please. So just a caveat, I am not a government official. So I have just taken information that is available from public domain. So don't blame me if something is wrong, but I can assure that whatever is here is 99.99% correct. There is something called RBI's LRS called Liberalized Remittance Scheme, under which one person can invest up to $250,000. This number changes in a while. They keep on changing this. It was 175 at time. It reached 200. Now it is $250,000 per calendar year, per financial year. So that is the amount of money that you can send overseas to invest in stock markets. So I'll just read out the line. Under the scheme, resident individuals are free to acquire and hold shares or debt instruments or any other asset, including immovable property outside India, without prior approval from Reserve Bank. So this comes straight from their website, guys. So a lot of people are asking me whether it is allowed, whether I can do it, whether I cannot do it. So yes, you can do it. You can go and buy shares overseas, as per Indian guidelines. You can also invest in units of mutual funds, VC funds, promissory notes, etc. under this scheme. So there are other options also available apart from securities that you can invest in. Next slide, please. And then obviously there is a list of prohibited items. It is like, when you are going on a plane and they will tell you a big list of prohibited items that you can carry with yourself. So the same thing is here. There is just always remember that anything with the word margin in it or leverage in it is something that RBI is kind of against of. So, you know, if a product is there which is giving you margin, or if you know, leverage, then that is not a product that you are allowed to trade as an Indian resident. Yeah, but if you're a non-Indian resident, then it changes drastically. But if you're an Indian resident, then those are the prohibited items. But you can go ahead and buy stocks, you can go ahead and buy debt instruments, you can go ahead and buy mutual funds, you can go ahead and buy promissory notes. So a lot of products that you can actually go and buy. There are some products which you cannot buy, and be aware of them when you are investing in global markets. It's very important. Next slide. So just to give you a brief, yeah, you know, obviously I take this opportunity also blow my trumpet, you know, so just to kind of tell you as to who we are. We are a very young company. Last year we are set up in Bangalore, and you know, started by people who believe that stock markets can actually make money for people. And we help people, we have been helping them through education, we have been helping them through training. We also are into advisory. We help people understand what to do, what not to do, how to do it. And I cannot guarantee any returns. Yeah, that is what the thing is, but I can show you the path. That is what our company has been doing. Very, very young. We are very enthusiastic about all this. And you know, when we come and see such great experience, people talking about lot of experience, you know, we with our you know, some 15 years of experience are very young compared to them. But having said that, we have a lot of global exposure. All our directors are people who have spent time overseas. They understand the global markets, and that is what we bring to the table. So thank you so much. If you have any questions, I'll be more than happy to take them now. Thanks. Can you go to the last slide, please? Next. Next. Thank you.
Any questions? So please continue. There will be questions, I'm sure.
Sure. I think there is one gentleman there. There's one gentleman there.
Sir, please reply me, who are the watchdogs for the global stock market, and what is the role of corporate governance?
I'm sorry, can you please repeat the first line?
Who are the watchdogs for the international stock market, and what is the role of corporate governance in controlling stock market?
Who are the watchdog?
Watchdog.
Okay, okay.
Watchdog.
To be very frank with you, I am not very confident of the first question, but I'll take the second one. I used to work for ASIC. ASIC is the Australian Securities and Investment Commission of Australia. It is the SEBI of Australia, you know, and the amount of time, energy and effort that is put by those governments in regulating the companies that are invested in or that are formed in Australia is really appreciative. It's a lot of time that they spend. Apart from that, finance is something that is taken very seriously overseas. I'll give you a very good example. We came up with this concept of IFA, you know, the financial advisors. When do you know the SEBI has started this act? Do you know when SEBI introduced this act? 2013 January is when IFAs came into existence formally. Financial advisory is available in Australia since last 20 years, you know. So it is not, you know, it is a very highly regulated markets from a corporate governance perspective. I'm sorry, I will have to get back to you on the first question later. Yes?
Okay, so just let's take an example. If I want to buy Google, right? So can you tell me what are the transaction costs involved in terms of A, what is the brokerage that I will have to pay, and B, what is the forex differential, as in what is the differential between the RBI rate versus the rate which I will be charged?
Okay, so the first thing is that the brokerage depends on different brokering houses like it does in India. If you trade with us, our partner charges $2.5 for a trade. Okay,
That's a flat fee.
that's a flat fee.
So even if, for
Okay.
example, it's 2.5, if the transaction value is $1,000 or $10,000,
It doesn't matter. It's $2.5 flat fee. And coming to the second question, the currency fluctuation or the currency is managed by your bank. So basically, you send money from your Indian bank to our overseas partner, and the exchange happens in your bank. And so first you give them Indian rupees, they convert it to US dollars, and they send US dollars. So whatever currency is managed, exchange rate that you can get your bank is the exchange rate you get. When you ask for the money again, it comes in US dollars to the bank converts it from USD to INR and gives it to you. So that's how the exchange rate works.
So just one process to and fro, you lose at least 4 or 5%.
Sorry?
One process to and fro, you lose 4 or 5% in exchange conversion only.
To be very frank with you, it all depends on how. See, if you're going to send money, you're not going to ask for the money tomorrow, right? So you need to consider some time that you will give it to it. There will be some exchange cost, obviously, but you can negotiate it with your banks if you're going to do it on a regular basis. We are talking to a few banks already who are going to help us bringing down the cost of exchange.
How much is it currently?
Sorry?
How much is it currently?
It depends from bank to bank. They have a spread.
What's your best rate right now?
Well, very difficult to tell, but yes, it is a cost there which will be associated with your
So
transaction.
practically, first you have to send the money, then once the money is in the credit or the broker's account, then you can buy.
Yes, so once the account is funded, then you can buy and sell the shares.
And how many days does it take to open an account?
About 1 or 2 days, it's an online application. Funding of account takes another 2 to 3 days.
Okay.
Thank you.
You said about remittance of 2,50,000 US dollars. So is it usable for the forex tradings? What people outside say that they open a forex trading, international forex trading platforms.
So I told you, right, anything with the word margin in it or leverage in it is something that RBI is against of. So be careful of those guys, yeah. You only can trade in forex or currency with an INR in it. You know, there are 4 pairs right now which you can trade in. Apart from that, any other pair you cannot trade as per RBI guidelines.
Gaurav, thank you so much for all the wonderful session that
Thank
you
you so
had
much.
today. In fact, my 2 worries are, first is about the global markets, as you said. As of now, since there is a recessionary world, majority of the economies are actually getting into a recession. We are seeing a slowdown for last, I feel, 5 to 6 years in majority of the big economies globally. So since US is one of the very stable markets as of now, very people are quite confident about US. But in your presentation, since it is one of the overvalued country, so do we still consider US? Because I think majority of the large cap stocks that we consider would be definitely at premium. So do we only consider large cap stocks in various economies, or it's also the mid cap space that we cater to? Question number 1. Secondly, whenever you all initiate a trade, so it is the at every trade that we do, since we definitely access to foreign exchange risk. Let's say if the currency depreciates further, so do we also have that hedging thing done at every trade that we do, or it's absolutely open?
I'm sorry,
Because
I didn't understand the second question. I'll just answer the first one and then we'll get to the second one. So, according to that slide, even India is overvalued, right? But does that mean that you will not invest in India, or there are not opportunities available in India? So the slide was just to give you a showcase of where the world markets are. Yes, US is overvalued as per the PE, trailing PE and P by B. But having said that, there are a lot of opportunities available in the US markets as well. There are some very good companies which are managed very well, and they can actually do excellent in terms of giving you future returns. I'm sure if sir does the same quarterly analysis that he does on Indian stocks with the US stocks, he'll probably see there are a lot many undervalued stocks there. You know, so yes, there are a lot of opportunities available even if the market is overvalued. So I'm sorry, can we repeat the second question, please?
Second question is related to the actual gain that we get. For example, if we initiate a trade, and as of now, this rupee is somewhere around 68 to a dollar. Let's say if the rupee depreciates further by, let's say, 10%, and the total gain on the trade would be, let's say, 20%. So instead of 20%, do we have that risk, or you all already hedge that position the moment trade gets initiated?
No, so that hedge companies, and we give you advisory on what kind of stocks to buy and sell. Another thing is, like India, even the markets that you're going to trade in, suppose you're going to trade in, say, US market, you know, they also have a SEBI there, right? It is called SEC. So they have their own investor protection programs that help you against anything that is going to happen with the company. So you depend on the, the corporate governance or that I was talking about of that particular country. And believe me, sir, it is well protected, even probably a bit better than what we are doing in India, you know. So,
Hello?
yes.
Yeah,
I'm
here.
sorry, where? Okay.
Yeah.
Okay, sorry, yes.
Hi. Hi. What kind of minimum ticket size of investments we are looking for investing in? Say, for example, we have said in remittance around $250,000 we can do. So what is the minimum ticket size we can invest? That is question number one. And question number two is, do we have any team in your company who is managing like a PMS, that we are giving, say, 50 lakh rupees and they are managing entirely the portfolio? So is there, the system is at place?
Okay, so the answer to the first question is that we generally recommend people to start with a $1,000 account, because that gives you a little bit leverage or little bit, you know, time to adjust, you know. If you start with a $500 account or a $100 account, that is not going to take you anywhere. So you'll probably, as he said, you'll probably pay a lot of transaction charges, then actually make some money. So you start with at least $1,000 account, and then the limit is 250,000 per calendar year. Financial year. And so that is one thing. Second thing is, as of now, we don't have that service, but we are planning to get to that, and probably soon launch that product. Thank you.
Okay. So how does the taxation work? Do you pay taxes in the US? Do you pay in India? Is it the financial year of the US? Is it of India? Do you pay taxes both places?
What you do is, when you realize the funds, you pay your taxes in India.
So only when the money is bought back, you pay taxes.
Yes.
And what about US?
It does not happen. See, what happens is, basically your trading account is a US dollar account.
Correct.
Okay, so the exchange rate only comes into place when you send the money or receive the money. When you're trading only in US dollars. Okay, so that's why that currency fluctuation is kind of taken care of automatically, because you are trading in the, one currency. So the hedging does not come into play.
But being an Indian consumer, or I would say Indian investor, obviously at the end of the day, you will all the time value it in INR terms, right?
I know, but that you have to consider only when you're going to ask for that money back. So suppose that, I'll give you an example. Today you send the money, okay. Say the rate is 66 rupees, okay. So you send 66,000 rupees. So you're sending $1,000, you send 66,000. After you trade with that $1,000, tomorrow it becomes, say, $1,200, okay. And you are going to ask for that money back. Tomorrow the rate is, say, 70. You will get 1,200 into 70, So in between that, when it gone from 66 to 70, it might have also gone to 64. It might have also gone to 68, but you will get the exchange rate for that day when you are getting your money back.
So that's actually on the individual side. He himself has to take that. And when you talk about Japan, like Japan is one of the very undervalued countries, as you said. But since that country is actually going through deflation for quite some time, so I think in majority of the research reports that I have read, that there is not enough opportunity actually in Japan, so as they want to invest somewhere outside, probably in the emerging economies, to get the better ROI. So how true is it?
So, see, Japan is a different beast altogether. Even if it is not doing good, the companies there are very good, If you look at the way the companies are managed, see, Japanese are very hardworking people as well, yeah. So, the companies that are managed there, they are, done in such a way that, I'll give you an example. Most of the Japanese companies, they have huge cash with them. If they start giving those cash as dividends tomorrow, you will see that, the stock prices will soar like anything. That is one thing. Second thing is that the recently the Japanese postal office got their IPO listed, and that was a huge success. So there are some very recent factors which are telling us that there are many good opportunities available in that market. Overall, the market might not be that great or not doing well. Even China, for that matter, everybody is saying that China is slowing down, but you think of it this way: in January, Chinese market fell by 20%. Don't you think that now there will be stocks available 20% cheaper? There will be a lot of stocks which got just hammered because of the market, just like what the Indian market did. So we fell by 5%, they fell by 20%, So it doesn't matter what the economy is doing per se, but we need to look at particular market and then pick the right stocks within that market.
My last question.
Sure.
When you look at various sectors globally, so don't you think metal is one space which, when you guys, since you
Which
all are
one,
global,
sorry?
metal sector
Metals?
across?
Okay. Is doing better?
No, in fact, are you all looking at metal to focusing hard?
We look at companies per se, it doesn't matter which industry it is in. So that is the thing that we look at. Yeah.
Thank you.
No worries. Thank you.
So,
Yes, sir. I'm sorry. There's one gentleman, and I'll take yours.
I'm not clear whether the account is a dollar denominated account or it is a rupee denominated account. That is number one. And number two is how just to trade will help investor protection. Even in Indian market, you have so many companies, there's analysis, studies, etc. How just to trade will help us in getting right company in those stock exchanges.
Sure. So the first question is that it is a USD denominated account, basically. It's not an INR denominated account. Second is that we provide analysis on different